the more you know, the more you're willing to embrace it.
A lot of baby boomers not feeling exactly like they have the right plan in place. There's a lot of regulations that didn't exist and folks were put in bad situations entirely. Like, this is a new era of this type of tool.
You have a homeless person and he's sitting on this box, not realizing there's $100,000 sitting inside this box that he's been sitting on. And that's like the same thing with this, is like you're in this home that holds all this equity that you could tap into.
There's no other mortgage other than a first-time homebuyer down payment assistance program that requires housing counseling. You are required to do counseling before you get a reverse mortgage.
They don't realize they're sitting on the thing they're hoping for change.
There's all sorts of ways to combine these, but the purchase is what's interesting too.
Yes, and I think that's interesting for Flagstaff's market.
Welcome, Ashley. How are you doing?
Good, how are you, Chris?
Good, doing really well. Welcome to everyone to this is Ashley's third time.
Third time
on our podcast here. So Ashley Berardi and with Remax.
Yep.
Fine Properties.
Yeah.
And so we are super excited as you and I were talking about something specific that we wanted to dive into today. An interesting topic that has some stigma. A lot of sensitivities.
Yeah, I think so. But I think it's a knowledge base. Like, the more you know, the more you're willing to embrace it.
Yeah. So, and specifically, we wanted to get into. So let's tease a little bit. I mean, it's probably somewhere in the title, somewhere that someone saw this. But let's create the use case of why we wanted to get into this. As we're seeing a lot shifting, right?
Yes.
Have you heard the term silver tsunami?
Yes.
Yeah.
Yes, it is a real thing.
It is a real thing. And so, Google this, and just a matter of, there is the baby boomer generation has a significant amount of wealth. And we're going to jump into that. Van, if you actually want to jump into that slide, there's some simple retirement facts. And I'll share my screen here with you, Ashley, to where, so baby boomers, that 60 to 78-year-olds making up approximately 20% of our population, owned 46% of national equity. And sorry, if you're a first-time home buyer, this is not the slide for you. Like, don't tune out. This is not your program. Because the folks that have bought up a lot of the real estate and own $18.65 trillion worth of.
But this goes to show you too, like,
equity.
What a great investment real estate is.
They've held it a long time.
Yes.
Correct. But according to AARP statistics, 52.5% of peak boomers have less than $250,000 in retirement assets, but have a median home equity of $156,000.
Which is amazing.
And when we talked about this though, and it's very much, when I saw some of these statistics, I was like, yeah, no, it's completely true. Right. And it's just like, yes, there's certain, we've seen all sorts of different, averages here, or median here, that we see different situations. But I have personally experienced many people in my life that fit this mold, right? A lot of folks that were fairly conservative in market investing, and not saying that, what we're about to talk about isn't great for folks that have a lot of retirement assets as well, but that because they bought homes, they believed in home ownership, they paid off their mortgages, and they have a ton of equity in that home. And then, but sowing in some of these additional polls, 88% of U.S. seniors stating their desires to remain in their home, so age in place. Well, 10% stayed there. Only 10% stayed there comfortable with their finances. So we're kind of seeing this dichotomy of a lot of equity out there, but yet a lot of baby boomers not feeling exactly like they have the right plan in place.
Right. And I think something that's huge too is what I see with a lot of buyers is, especially when they're buying like a second home, or they're in their mid 60s to late 60s, is they are thinking that this is probably their last home.
Yeah.
Like, they're thinking single level. So they're thinking through these things. They plan on staying in these homes. But I think a lot of people forget about the money that they have built up in these homes 10 years after they buy it.
Yeah. Or, yeah. And could even be thinking, I would like to get, like, here I have my, free and clear home and everything, but I'd like to get into something I can age in place better, closer to, especially here in rural Arizona, we deal with this, right? The folks are like, hey, I need to be closer to, like, It was beautiful out here in the county, but I got to be, I don't want to be shoveling my big walk anymore. I got to get off the dirt road. I, need to be a single level, closer to facilities, closer to community. And so all these different things that then they can feel held up. And if the financial picture just, in their mind doesn't seem to track.
Right.
And so where we go with, and then this is we're not experts in this, but this is something that was shared with me, and jump on this slide, Van, is also when we talk about if we're aging in place, what are costs? And these are just, you can see the data references and citations on that this is just data I'd that shared with me, is that the cost of aging in place can stack up very quickly, like in-home healthcare and those types of services.
Right. Well, and it's something too where this might happen.
Yeah.
Like this is inevitable.
Yeah.
Like, you're going to keep aging, and you're going to eventually have to somehow figure out how to pay these costs, whether in place or, if you sold and went into a home.
So, yeah. And so not to go into too far of a roundabout, but where this really comes into is understanding reverse mortgages, right? And an understanding, and really what I'd like to, our audience to understand, I'm hoping that if you're thinking right now you're thinking of the use case, right? I want you, if you're listening to this right now, to think about your parent. I want you to think about if you are in this or entering this age range, or if you are pre-retirement or in retirement, or there's so many different ways that this can then benefit. Right. And I want it to be very much, an honest conversation to say, yes, there's a lot of regulations that didn't exist, and folks were put in bad situations. Entirely, like, this is a new era of this type of tool, to say it's exactly that. Like, I think we were talking about this, and you were sharing like the the fun analogy that you were saying about the guy sitting on the corner.
Yeah. So like, it's almost like you have a homeless guy sitting on the corner. He's sitting on this box, and he's been sitting there on this box every day for, let's just say, like, I don't know, 3 months. And he's asking the universe for help, and he needs, an abundance. He needs some money. He needs some, food, all this stuff. And he's sitting on this box, not realizing there's $100,000 sitting inside this box that he's been sitting on. Yeah. And that's like the same thing with this, is like, you're in this home that holds all this equity that you could tap into.
Yeah.
And you could free yourself and be able to do these things, or pay for these kind of in-home care costs with what you already have, and it not cost you anything.
Absolutely. And so, again, all these folks and families that are coming together trying to figure out, how do we build out the budget for mom, right, or how do we do this, to where we want to dive into a bunch of use cases to start the creative juices flowing for people. But before we do just yet, though, we did want to kind of talk through a couple of kind of qualifiers, so that people understand where this can even start to help.
Yeah. And so that it's a smart decision too. Because
Absolutely.
It's like, you really have to kind of think through this, look through the qualifications, make sure that this makes sense for the age and what we're looking for in the future here.
Exactly. And again, full disclaimer, this is a brainstorm in and around these tools. You would 100% need to then consult, with experts and professionals.
And your financial planner too.
And your financial planner. I guess we start out the gate. There's required counseling. That's what's interesting. There's no other mortgage other than a first-time home buyer down payment assistance program that requires housing counseling. You are required to do counseling before you get a reverse mortgage.
Which I think is good. I think it's
Absolutely.
Good, because I think people need to talk through everything and make sure this is really a good fit for them. Because it might not be for everybody, but for some, this may be the one thing you've been looking for, and you've been stressing over how to come up with these funds, and you're sitting in it.
Absolutely.
It's right there at your fingertips.
Yep, exactly. And so a couple quick things on that then is, so the Federal Housing Administration rolled this out in 1989, and then it allows for senior homeowners to tap into to their equity, into their principal residence. So again, it does have to be primary residence, must be, so at least one borrower, as we'd call them, must be at least 62 years old. And so if it's a couple that are getting the reverse together, if at least one of them is 62, they can be on the loan together. The older the borrower, the more money they're eligible for. And so this is something where it's a different qualification parameters, that age base, you can then get more money the older that you are. And so that's where it's built in to help you preserve equity and to preserve
It's protection.
Protection. Yeah. To say, we're not going to max you out on the home here
Right.
necessarily, that there's calculations on that. The youngest borrower age is used for calculations on that equity eligibility. With the reverse mortgage, you never make a payment. You can actually, but you never have to.
Right.
And then, unless you choose to, and then if I click onto this next slide here, is what's also important. And actually, I'm going to skip to the bottom of this, or actually it's on the next slide, but let me walk through, is there's a lot of different ways that you can digest this. So this is, again, all new information that people are wrapping their heads around, that yes, you can do a refinance, right? If it's just as simple as like, hey, mom and dad are struggling paying the mortgage, but they have tons of equity, but this, they owe $100,000 left on this $600,000 home. You can do a reverse and just and make the payment disappear. Right. So it can be as simple as that, or it can be a matter of, as we then kind of dive into some of these use cases, it was kind of fun to see that line of credit piece.
Yeah.
Is actually the most popular of folks saying, hey, we have variable expenses coming up. We might need to put a new roof on the home. We might need to have some medical expenses done. We might need to take care of in-home care expenses, or, hey, we want to be, the ones to help foot the bill to take the kids to, the beach this summer.
Right.
You can use this line of credit for these types of things.
And so and just correct me here, because we kind of talked through this, but it's basically it's like a HELOC.
Yep. So
where they don't have to use it, but it's available for them to use.
Correct. So just like an equity line of credit, if you were someone doing a forward, I think forward and reverse here, a forward equity line of credit to say, hey, I have an available line amount to me and I'm going to utilize it. And as I utilize it, I accrue interest on just what I'm using.
Right.
And that same thing works in reverse to say, okay, you have a line or a limitation of what you can use. And as you need to, you can utilize that line, and you're only accruing interest against the home and against that reverse balance that is against what you're using.
Right.
Right. So such a cool tool, right? Because again, with folks, and a lot of folks in this situation start to feel like doors are closing, right? Of like, oh, I don't have a job anymore. I don't have any other income sources. I now have this like Social Security, and that's guaranteed at this. And then my financial advisor is telling me, based on what market's doing, this is all I can pull, or what's. So you start to feel like this world is strict. Yeah. And then
it's starting to tighten on them.
Getting more expensive.
It's just they don't realize they're sitting on the thing they're hoping for change.
Yep, exactly. And so, and then you can do one-time distributions. If it was just a matter of like, hey, we have a specific goal or want to fund something, you can do one-time distribution, or a combination of like paying off a mortgage, getting an equity line, so there's all sorts of ways to combine these. But the purchase is what's interesting too.
Yes. And I think that's interesting for Flagstaff's market, because we're, as people age, it's harder in the winter. You've got, snow, you've got ice. And so a lot of people want to be down in the valley in the wintertime. And so doing a reverse mortgage, it frees up that equity that they've got, that they could then use that to purchase a condo or a single level house down in the valley, spend their winters in the valley, and also keep their Flagstaff house up here for the summers too, because it's kind of the best of both worlds.
So, and it's almost like all of a sudden, I don't know, I'm just thinking of that, that spaceship that went around, the moon here, of like, once you lose gravity here, we're thinking of a forward mortgage, and then all of a sudden you said reverse purchase, all of a sudden we lost our orientation of how this works, right? I don't know if it's a great analogy. So let's talk, I want to spend a little bit of time talking about that. So if we do a reverse purchase, meaning you're getting a loan,
right?
But it's a loan that accrues interest against the balance of the home.
Right.
The balance against the home is growing, and you never make a payment.
Right.
Why would that be helpful? Well, let's talk about it. So, you sell it, you sell a $700,000 home in Flagstaff, right? And it's free and clear. And you're then going into this home down in the valley that is, there's all sorts of different ways we could go with this, but let's just say that it's a light value of $700,000. But you're also then making this move, and you're worried about expenses forward. You're talking with your financial advisor on affording life down there and everything. And you decide, hey, let me get a $200,000 reverse mortgage So I can actually put $200,000 of the proceeds of my home
Right.
into my retirement account. And I'm not talking to my financial advisor about how can we afford this mortgage. I'm just saying, how do we grow that to help me afford life down the road?
Right.
And I've now funded my retirement account, sold a home, and now where I want to be is funded my retirement account and have this small balance that on my home is growing, but I never make a payment.
Right. And you've got, like we were talking about, you have equity typically over history has been about 4% is what you're gaining, on what the value of your home is. So you've got that working for you too.
And let's actually jump over to that here real quick, Van.
Yeah, because I like these slides.
This is my favorite slide ever. And that's what's, if you sit down with any financial advisor, they're not going to tell you what, no one has a crystal ball. They can't tell you what your money's going to make if you invest in
either way,
stock market or whatever.
Right.
But what they will do is look at historic performance.
Exactly.
And so if we look at the historic performance, this is nationally of real estate, going back all the way, my eyes are so bad, Ashley.
We're getting older, Chris.
1942, all the way back to 1942. That real estate goes up. If I jump over here, 74 out of the 82 years charted on this, it
Good
went
odds.
up.
Good odds.
Good odds. But that does go so far as to say, and that's where we're jumping around a little bit here, but to say your home is growing value on the total value of the home. Even I'm talking about first time home buyers being hesitant in this market and everything happening. Like they forget that that's the huge magical thing about real estate is you grow equity on the total value of the home.
Yes.
And so even if you in that example, you buy a $700,000 home and you have a reverse mortgage that, $200,000 or something of that nature, right? That the home is gaining 4% equity year over year over year.
Right.
Or on average.
On average.
Good years, bad years,
There's what, 7 years there?
Yeah. Sorry.
But still out of the 74,
yeah.
yes.
And but that you're borrowing against that equity as well, right?
Right.
All right. So in this chart, so let's jump in. We're deep.
I know. I love this next chart.
Okay. So everyone go with us a little bit here. So
this is
you're
where it
gonna
gets
have
interesting.
to kind of pause here. And this helps you kind of see a little bit how this works. So again, full disclaimers on everything. This is just a sheer example. Your specific situation would be very specific to your nuances. But I wanted to share this because this is where it caught my aha moment. The use case of a client that I was working with that in this specific use case. So I'll give the exact what we're looking at here, but then it's similar in a lot of different reverse cases of that we are looking at a client that had a mortgage on a property, about just under $200,000 on the mortgage owed, and they were worried about upcoming expenses, and they had lost a spouse, and their Social Security had gone down, and so they're thinking of forward and having seen that event of the loss of spouse of like, okay, what am I going to be facing with medical expenses and costs? And so what we wanted to do is say, okay, step one, let's eliminate the mortgage. So you can see that we started with a principal loan balance of $197,000. What this person, if you look then at this chart, there's this line of credit. So what this client also then had access to is that we would pay off their mortgage. They no longer have a mortgage payment, but then they have access to this equity line of credit that does with age grow so that basically they have access to more. Like it doesn't happen on a forward. Like you go, talk to the credit union, get a $100,000 mortgage for your renovation. That's it. You got to go back to them and requalify for more money. But this actually grows so that down the road, as their equity is growing, as they're aging, they have access to more funds. But what's fascinating here, based on a $650,000 property, you can see the property value, and just based on that 4% year over year appreciation, you see how the value of that home is growing. So much so to where. So the loan balance against the reverse, if they didn't take anything on the equity line, would be $422,000 in 10 years. So most people stop there. They're like, oh my gosh, why would I ever do this?
Right.
But to see that home is now worth $692,000.
Right.
They started with $452,000 worth of equity. They would be in 10 years at $539,000 $539,000 worth of equity. And that actually, and that's 539. Yes. So that is then assuming they didn't take anything off the line. If they take something off the line, that does shrink that equity position as well.
Right.
But then it also starts to talk into the planning, right? Because we were talking about being in a situation where, and I was actually, so Mom, love you if you hear this. But I was even talking with my own mother. Like that, to the extent that I believe this, I would talk about this with my own mother. Where I was like, hey, one of your largest assets is your home. And instead of you going and coming to a situation with, with the aging costs of life that I turned 40 next year, Ashley. And so I'm going to have to say, but
11 years
like I am learning more and more about the cost of aging as we go on here. And I'm like, instead of you coming to us kids to say, I need help, you're sitting on this box. I love that analogy. Right. You're sitting on this box of a massive, massive asset that I wouldn't want you to utilize for you, versus me saying, yours. Let me cut you a check, and I'm hoping that I'll get a check like morbidly after a funeral, And so but that's just and
it's also like we were talking about too. It's like your money, like us kids, is sitting in these accounts building interest. Where this is tax free to do this.
So that's the other aspect that comes in. So many things. This one is then yes. So if
you're not even you're not maximum, like you're taking away.
Yeah. So again, looking at so many different use cases so let's say you sold the $400,000 home in Flagstaff and you wanted to be near family, so you need $500,000 for that home. And you're thinking, Kate, you talk to your financial advisor, you're like, do I pull $100,000 and I impact my taxable income that year?
Right.
I pay, and pay, capital gains and all these different, things that couldn't be incurred as you're pulling on your assets. Whereas if you do a reverse mortgage, it is debt. It is tax-free.
Which nothing's tax-free.
So
this is amazing.
It's definitely a strategic tool. Again, partner with that financial advisor and partner, look at your projections here. But whether it is, again, I just get blown away with all the different use cases.
I know
we start talking about case studies and it's
mind
like
around it.
You do. But in so many situations where it's like, and everyone, Ashley had your back. We did delete a chart that was super confusing, but it even shows like this is not just the use in case of emergency tool that you can say, hey, work with your financial advisor and understand, if we had this reverse on a purchase or a reverse to where we even said, okay, another phone one here. Sorry, we won't go into.
I know. I got another thought too.
We would love to have that condo down in Phoenix by the kids, but just how do we afford that? And if we pulled investment assets, then it's going to hurt our retirement and things of saying, no, you could do a reverse on your primary residence here in Flagstaff to pay cash money for your second home that you pulled non-taxed, and you never make a payment on that condo in Phoenix.
And now you have another asset.
Now you have the lifestyle that you wanted to do. You're not tapping into your investments. And yes, will that impact the equity you have in the home when you die? Yes.
Yeah. I know. And we could go down a whole nother road. Like my brain's going crazy because I'm like, now when you're saying that, Chris, I'm like, oh my gosh. I'm like, you could even buy the condo in Phoenix. So you have the two places. You could even tap into some more income by renting one of those places out half the season when you're not using it, if your HOA or whatever allows it. So now you're making money on something you purchased with tax-free money.
Yeah.
So I kind of look at it like this, like it's the difference between a regular savings account and a high yield savings account. Yes, you're putting the same amount of money in, but one is just like maximizing what you could be making on that money. And that's what I see this reverse mortgage tool as, is you are maximizing safely. Like you're not relying on, the stock market and did you time it right or whatever? Like you're getting to enjoy life enjoyment. You worked your life for, to retire. Now you have a way that you're sitting on that you get to enjoy your life and buy, another property if you want that you could do as, rent it or however you want to do it. when you're not using it, but then you get to stay in your home that you've built your memories in.
Absolutely. And I think that that's the key part is that's the full spectrum, right? Whether it is like you said, you're sitting at the kitchen table, you're stressed because you don't know how you're going to afford groceries next month.
Right.
This can serve that tool. Or this is all the way to the other spectrum of like, hey, we want to create fun life opportunity and buy an investment property and utilize that to or second home type property and short-term rental it or all
Right.
that. This can be a tool in which you then can create that opportunity. And one thing that I wanted to then, jump into then real quick is, let's see, and then Van, when I get to this one, I'll have you share the slide if I can get back to it. But I did want to share, so to just round out on some of these stats then, or facts, I should say, that you always own the home. You do have to pay it back once it's not your primary residence. You have 12 months, right? So from the event that you move out or you're no longer utilizing that as your primary residence, you can, the estate or you can sell it, you can refinance it into a different mortgage, or you can pay it off, right? And so then you have to continue to maintain the home. And then, underwriting guidelines are much more different than a forward mortgage. But the other piece that I wanted to, this is the big piece, is this is non-recourse, right? So they can be, again, upfront, they can be quite expensive because there's an expensive insurance policy that basically covers you to say, if the stats of 4% year over year, or, as it's growing or whatever's happening for whatever reason, if you ever owed more than on the home than it was worth, you or your estate will never see someone knocking on your door to collect a penny.
Right.
And then that's the last piece, is that the equity doesn't go to the bank, right? It's not like now the bank owns your home, and it is yours or your estate's. Right. And so that's where I think is so important to talk about these things. Again, when we look at projections, and that's where you don't have to be so case by case and cater these to, specific goals with the client, and talk about, the time frames that you would want this tool, and where would your equity be, and how does that impact your goals with your estate. But again, I'm seeing so many people anecdotally, and I would say, it's ironic that I say that statement, we have very few conversations about these. That's the sad truth.
Yeah.
That there's a lot of folks that just don't know about this, or are nervous about it, or don't even want to have a conversation around it. But then the ones that we do, it is amazing to see that there are many, many folks in this exact age category with 6-figure, in some cases 7-figure equity in their home, that are just feeling like they're stuck in some way, shape, or form, or hate the idea of a payment. And it's like, no.
Right.
There's a tool here.
Well, and I think especially with the Flagstaff market, because we do see so much growth in the price, that there's a lot of people that are sitting in these homes that they've owned for 20, 30 years, and they have no idea that they are sitting on this financial answer, amazing tool that could provide so much more of a happy retirement lifestyle for them.
Yep.
And they're sitting right on it.
Absolutely.
It's almost like if somebody owns land and they have no idea under the ground, there is this big, huge, oil reserve.
Oh, yeah.
Right? Especially right now, and they're sitting on this and they just don't even know, because they haven't even dug down to get some facts and stuff about this.
No, and that's the truth of it. And again, I know there's a lot of folks that are, maybe just feel like the real estate market ran too far off the rails, or are trying to get in the market right now. But it really is like you bought that lucky stock. If you own real estate in Flagstaff and you've owned it for the last 10, 20, 30, 40 years, like you own oil. Like you own, like it's one of the, as far as like what type of like most valuable investment could you have right now, and the way that has appreciated for you. I mean, I think if we looked at, that's my other favorite chart that I don't have here, is like real estate appreciation in Arizona in the last 40 years is over 400%.
Yeah.
And that's insane. And so it is insane, but it's yours. Right. And great if you are totally good to go and you have enough cash to fund your dreams, and you can just hand that all off to hand your equity off to your, estate and kids and grandkids. What great. But a lot of folks are in that situation where it's like, there's some gaps.
Right.
And whether that's a life need, necessity, or a lifestyle goal, there's those wants, needs, wishes.
Right. Well, and I think it's one of those things too, where it's like they bought the house for a minimal amount,
Yeah.
which is crazy. They bought the house with minimal amount, and they, like you said, they've worked to pay off the mortgage, and they just don't, they think there's no other answer but selling.
Yeah.
And here it's like, no, there's some other answers here.
Exactly. And so I think, I think ultimately I hope that whether you're thinking of you, the listener, are thinking of grandparents or thinking of, your parents or yourself, you need to understand whether you are, whatever need case basis you have, you need to talk to professionals that understand these products.
Yes.
And don't just try and filter you into what they know, right? Of like, we'll just kind of one size fits all, throw you into a forward purchase or give you an equity line of credit versus looking at reverse options. So Ashley, myself, would love to talk to you, right?
Absolutely.
And connect with you. And again, it's consultation, it's conversation before we're ever even, taking any next steps on anything. It's let's understand your goals and really open up to the totality of options that the tools and the equity you have can open for you.
Absolutely. And I think, looking at the numbers, it really opens your mind to it.
Yeah.
And it really does. It like makes you start thinking like, okay, let's see how this looks on paper. It's almost like when we look at renting for 10 years versus owning a home for 10 years. Once you see those numbers, it really makes your brain start going crazy on thinking.
And partnering with financial advisors, that we've played a lot of these scenarios out where I'll see case scenarios where they have a client scenario where on their metrics, and they have some of the financial advisors we usually work with, they have this percentage likelihood. And it's like, no, they're 60% likely to hit their goals in retirement. And then we say, well, what about the home equity? And if we did this reverse tool, and it's like, okay, it just is a matter of then utilizing the tool that exists in that client's arsenal there or quiver. And all of a sudden they go to 90% or 95% or 100% of saying like, no, if we can just use this tool accurately, then all of a sudden it works.
Right.
Whereas otherwise we're stressed, we're strained, we're calling family for help. Right.
Yeah.
So
no, I think it's definitely something to reach out, get some information on, because it could answer some big questions and problems and solve some problems for you right now.
Absolutely. Well, awesome, Ashley. This has been an awesome conversation.
Yes, thanks, Chris.
So much to unpack here. So I hope we made sense on all of it.
A lot to digest.
Yeah. Reach out to us, everybody. I hope this has been helpful.
Yeah. Thank you.
Thanks.